Hello guys, and welcome back to another episode of the MD Investor, the channel where we talk personal finance, increasing our financial IQ, so we can break the cycle of generational poverty. If this is your first time, welcome. If you're regular, you already know. If there's people out there you think can benefit from this type of personal financial information, let them know. It's MD Investor on YouTube and MD Investor One on Instagram. Today we're going to talk about interest rates. We're going to talk about interest rates. If you haven't heard, the Federal Reserve Chairman, Jerome Powell, just recently increased the interest rate by another 0.5%, or as they call it in financial lingo terms, 50 basis points. Each base is 0.01. So 50 basis points or 0.5 interest rate will recently increase. This is in addition to a previous quarter percentage point or 0.25% increase I think it was a couple of weeks ago. Okay, so question, what is the interest rate? Well, we kind of already know, right? Interest rate is basically the cost to borrow money. Simple. Cost to borrow money. So if you borrow $100 and the interest rate is 2%, you're going to have to pay them back $102. The $100 is the original amount you borrowed, the principal, and the extra $2 is the interest, the cost to borrow their money, because they didn't have their money for a whole year. And the interest rate is usually expressed in annual terms. All right. Sometimes you may see the term APY, annual percentage yield, like on your credit card. Essentially the same thing. They basically take the interest and divide it by, I guess, 12. Essentially the same thing. There's no significant difference. Okay, so what effect does raising the interest rate have on us consumers? It makes things more expensive. It makes borrowing money more expensive. So you want to get a mortgage, now the interest rate is going to be high. You want to get a car loan, you want to get a home equity line of credit, all that stuff. You want to buy furniture on credit, it makes everything just a little bit more expensive. I'm going to get into it later, like why did they do this and all that. So that sounds like a downside. There is one positive aspect of increasing interest rate, and that is you get more in interest when you put your money in the savings account, right? So, we bash savings account all day saying there's better ways you can put your money, and that's true. To get a better return. But one of the consequences of increased interest rate is that you get a higher interest rate, higher yield on your money that you have in the bank. Okay? So the interest rate has now been increased, which means that the cost to get loans are going to be more expensive. What should you do? Or what are some of the things that you may want to do when the interest rate goes up? One, we kind of alluded to, would be to pay off your high interest cards or pay off any loans you may have out there. So, whatever you were paying before the interest rate went up, it's going to be higher, right? And we're not talking about fixed rate loans like mortgage and so on, but we're talking about things that are variable, that are can be affected by increased rates, such as your credit cards, right? If you were paying 15%, now you're paying 15.5%. So one of the things you may want to do is pay off your credit card. Another thing you may want to do, again, we kind of alluded to, is you may want to put more money in the bank. It can give you a higher rate of return. Like I said, it's not the best way to do it, but that's one option you may have, okay? But paying off your high interest cards are definitely a great thing to do in a high interest rate environment. Let's look at what else can you do when the rates go up. What if you were thinking about buying a house? You were thinking about buying a car. You were thinking about taking out a loan for whatever reason. You haven't done it yet, and now the rate's go up. So you may want to hit the pause button and say, you know what? Maybe I will wait to buy the house. Let's just save our money in the bank or invest it or whatever, the down payment that we were going to use, and wait till rates come back down. So you may want to wait for your big ticket purchases in a high interest rate environment. Why did the Federal Reserve increase the interest rate in the first place? Good question. I'm glad you asked. Well, the Federal Reserve increased the interest rate because of inflation. As you already know, inflation is pretty much at a multi-year high. We think normally inflation runs 2% or so, and inflation, as you already know, is the buying power of your dollar. So inflation is usually about 2%. So a dollar in 2022 will will have a 2% less buying power than a previous year. Essentially saying that you can buy 2% less than you can the year before. That's what inflation does. It erodes the purchase power of your dollar. And that's why we always say when you're looking at your rate of return of your investment, you want to make sure you are at least matching inflation, right? Because if you are returning, if you're getting a return of 2% of your money and inflation is 3%, you're actually losing money. That's why putting your money in the bank is not such a great idea, because inflation is above or exceeds the rate of return you're getting on your savings account. Okay, so why did the Fed increase the interest rate? Think of the economy as a car. That's kind of how I think about it. Think of the economy as a car, the U.S. economy, the world economy, whatever you want to think about it. Think of it as a car, and it's going down the road, right? The car has an accelerator, right? And the car has a brakes. So the car has an accelerator and the car has a brake. Let's say the car can ideally, or the manufacturer recommended the car goes at 70 miles an hour. 70 miles an hour. It can go faster, but it can overheat and it can lead to some damage and wear and tear of the parts and so on. Now, when the car is going down the road and it goes at 50, 60, 70 miles an hour, everything is beautiful, everything is fine. But now when the car begins to go too fast, it can overheat. And that's kind of what's going on now in our economy. We are in an inflationary time, we're in the midst of inflation. And basically, inflation is, as we were talking about, is the cost of goods and services, the rate of the increase of cost of goods and services is exceeding the amount to produce it. So in other words, to say that again, the cost of goods and services are exponentially going up, and because it's exponentially going up, you know that we are not able to keep up. We all see what's going on. Gas. I think it may have hit $5 a gallon already. Food in the supermarket, we know that. Just everything, basically the cost to live is going up. And is your money going up? Did you get a raise from you? No. I think they said inflation is going at 2%. Now inflation I think it's about somewhere around 8.5%. Our purchasing power is 8.5% less in 2022 than it was in 2021. In other words, $1 in 2022 can only purchase 91.5 worth of goods and services. That becomes real to you, right? $1 today can only purchase 91.5 cents compared to last year. So if your income is not going up, to keep up, you're going to have to make some decisions. And that's what we're seeing going on. Now, so the economy we're seeing is kind of overheating in terms of we're in an inflationary period because of economic slowdown due to the world shutting down for 2 years because of the pandemic. There is a war going on in Russia and Ukraine area, which is affecting commodity prices. Because if you don't already know, a large amount of the wheat, the global wheat supply, is in Ukraine. And obviously, there's a destruction of the supply chain, which we kind of knew about. We see all those cargo ships on the coast or that able to be offloaded because there's not enough workers and so on, right? So we have a multifactorial reasons for the inflation. And because of that, the prices are going up. Also, you have a breakdown in the supply chain for gas, because one of the big suppliers of gas is Russia, and we have all these things going on. We have sanctions on Russia. So we have a global pandemic. We have sanctions on Russia. We have workers demanding very high wages, and a lot of things going on causing this inflation. Like I said, there are two tools that the Federal Reserve has at their disposal: the accelerator and the brakes. Accelerator to slow the economy down, and the brakes to kind of speed it up. So think of the economy as a vehicle, and now there's two sides to the way you want to think about it: supply and demand. Okay, the government really doesn't have too much control directly over the supply portion, but they have control over the demand. And because it's like think of it like a teeter-totter. When one goes up, one side goes down. They are linked. I said the Federal Reserve and other central banks, right? The Central Bank of Canada, the Central Bank of Japan, and central banks of all over the world. They have control over the demand aspect. How do they do that? Good question again. They do it by interest rates. When the government wants to kind of quote unquote cool the economy down, like they want to do it now, what they do is they raise interest rates. Think of it as the automobile industry. We have an inflation, right? So we have either too little amount of cars because of maybe there's a supply chain disruption. You can't get the chip to make the car. So there's too few cars out there. And because there's a demand for them, the price of those cars are going to go up. So what the government wants is they really want to increase the amount of cars so that the price will go down. But since they can't directly tell the auto manufacturers to make more cars or make them cheaper or whatever, they will raise the interest rate. Now that the interest rates are risen, it's gonna cost people more money to get a car loan. Because it's gonna take them more money to get a car loan, less people are gonna buy cars. Therefore, the most of the cars that are now built will remain, increasing the supply, and the price will go down, cooling off the economy. And you can use it for anything. We've recently seen a hot housing market, right? People overbidding and paying more than the asking price for homes. Stiff competition, right? Great for sellers, not really that good for buyers. Now that the interest rates are going to go up, new people coming in now, it's going to be more expensive for them to buy homes. Thereby, like I said before, if you're thinking about buying a home and you haven't yet, now that the interest rates are going up, you may say, you know what, let me save my money and wait. Now that you're going to wait, you won't be in the market, increasing the competition, less people will there take out mortgages, and then less people buy homes, and then the homes that are there, the prices will go down because there'll be an increased supply. Okay? So this is the basics, I think, of how we should understand increased rates, low rate, and how it affects us. Sometimes the opposite happens. We saw it in 2020, where because of the global pandemic and the shutdown, the government lowered interest rates to essentially to like zero. So it was easy to borrow money. And a lot of people, were borrowing money, they were refinancing their house, and they were going to Home Depot and fixing all that stuff because they were stuck at home. But now we're seeing the other end of the spectrum. Again, guys, quick video to increase our financial IQ so we can break the cycle of generational poverty. There's people out there you think can benefit, let them know about the MD Investor, okay? So in this video, guys, we spoke about the interest rates and how the central banks adjust interest rates depending on what's going on in the economy. We talk about inflation and some of the causes that can cause inflation. We spoke about what to do when interest rates go up. Okay? So guys, I will see you on the next video. And until next time, continue to command your money to grow. MD Investor out.